We are very good.
Okay. So last week we talked about ADUs. Okay, I just want to do a quick one on that. I mean, ADUs give you the opportunity to max out your property. I mean, what we're going to talk about today is just building equity through time and appreciation. Developing the ADUs allow you to build sweat equity. That's actually expanding your home or increasing the number of doors or rentals. And California, if you look at the guidelines here, for single family homes, California allows one detached or attached ADU and one conversion ADU plus one junior ADU. So that gives you three ADUs on your single family home plus your main home. So now you're up to a fourplex. Okay. The only caveat is the junior ADU is it has to be put on a deed restriction. Multifamily homes allow up to two, okay, attached or detached plus one
DJ, before
conversion.
you go on, I'm sorry, can I interrupt you here?
Sure.
Can you somehow be in the middle of the camera instead of you
Um,
are on the side of a camera?
yeah, I can't see myself. I'm full screen right now. I can't see it, but
You go on, move a little bit in, yeah, more, because I want to see you more. Yeah, that's perfect. Thank you, right there. Thank you.
okay. So, take advantage of these new ADU laws that have been put out by the California state legislation. This allows you to expand your square footage, increase your livable space, put in up to three rental units on your single family home. That's four dwelling units. You can go from a single family home to a fourplex. Okay. So this is what I would call a kind of sweat equity. Every dollar you put in, you're going to get $2 back. Okay. So that's what we talked about last week. And look for those opportunities. Okay, like here's an example of a site. Look at your property. Look at opportunities for doing a garage conversion or a porch or a backyard, large backyard area here. This is a corner lot, so you can actually do a driveway here. In the front is the existing, and then you can put an extra driveway in the back here. So there's all kinds of opportunities, I'm sure, with your existing properties if you already own a property. And that is also another really tried and true way to increase the value of your home and your property. Okay, that's what we talked about last week. So I just want to reiterate it. This week, we're going to jump into what we strategy called the housing ladder, how to climb the housing ladder. This is a tried and true technique to get you into your dream home within that 15, 20 years. Okay. So this definitely works. Okay. So, MC, you can interrupt me anytime you want to ask any questions or anything like that. But I'm going to walk through this chart here. It's pretty complicated. So I want to spend the majority of time on this, probably 10 minutes or so on this chart before we get into, some variations on this housing ladder theme. So what is the housing ladder, right? Okay, it's the same thing as climbing the corporate ladder, right? You can start at the bottom of the rung as an associate, work your way up to the CEO on the board, right? Same thing with the housing ladder. You can start at the bottom, which let's say is renting. It could be even further down, homeless or subsidized housing. But let's say you're renting and you're saving up money and you want to get into real estate and you want to get your first property. So here I'm showing like a three-step process here. Okay, so this is owner occupied, self use. You're going to keep trading up after you build up your equity. And the beauty of this is, time is on your side. So be patient. So this example shows like a starter condo, let's say back in 2020 timeframe. Let's say you just do a small 2 bedroom, 1 bath condo. And let's say you've saved up 10%, $32,000 to go ahead and buy this condo to get your foot in the door, get your first property. Okay. So that 10% down is going to get you a $325,000 condo, right? Well, at 4% appreciation, which is kind of the national average, 5 years later, it's going to be worth, 395K, almost 400K. So basically in 5 years, your home appreciated $70,000, right? And let's just say, for instance, you paid off about $5,000 in the loan. So now your equity is going to be like $75,000, right? So now you got appreciation plus you're paying off the loan, and that's equal to your equity. So now you got $75,000 in equity. Well, guess what? That's enough to put a 10% down payment on a townhome, a 3-bedroom, 2-bath townhome that sells for 575. So now you just traded up. You went from your starter condo, okay, with airspace basically, to a 3-bedroom, 2-bath townhome where you actually maybe you have a ground floor and you have a little patio, right? And you're comfortable there. It serves its purpose. Let's say you stay there for 10 years. Okay. At 4% appreciation, your 575K grew to 850K. Okay. So in 10 years, your property appreciated $275,000. Okay. That's appreciation. In the Bay Area, it's more like 7%. Okay. But the national average is more like 4%. You would do much better in the Bay Area. In the Bay Area, homes have been doubling, like 7% appreciation in the last 10 years. Okay. So your 575K now has become 850K. Now you got 275K in appreciation after 10 years. Plus, let's say you've been diligent about paying off that loan and you paid off 50K in the loan. Now you got like 325K in equity. Okay. So here we are, 15 years later, you can take that 325K in equity and now you can do a full 20% down payment on your dream home. Let's say your dream home is a 4-bedroom, 3-bath, 3,000 square foot home that costs $1.5 million, right? Well, 20% of that is 300K. Well, you got the 300K, okay? Because now you've been climbing that housing ladder, started here with a condo, go up to the townhouse, and then make it up into your dream home, okay? And the beauty of this right here is when you sell these properties, okay, there's a capital gains exclusion. Okay, you don't have to pay capital gains tax. Okay, so all this money, all the appreciation is what is taxed, plus your loan payoff, your equity, that's going to come to you tax free. Okay, so the only thing you're really doing is paying closing costs, and realtor's commission. I mean, albeit that's an expense there. So you can see from this simple example, the sooner you get into real estate, let's say you're 30 years old and you buy your first starter condo. Okay. Well, if you follow this strategy, okay, of just basically keep trading up after you build equity, in 15, 20 years, you're going to be in your dream home. Okay. And imagine what that dream home equity is going to be like in 10 years. Now your 300K is going to become like 6, 7, 800K. Okay, you're going to have a huge equity now in your dream home. So
So can I ask you a question?
Sure.
So for this one is the owner occupied property. So somebody buying a home to live in, and
Correct.
then
This is self-use. Yeah.
yeah, and then 5 years later they earn more more equity money, but because the home only appreciate, and they use that money from selling the condo, have some money for the down payment, and then now buy a house, right?
Correct.
House of and with the different down payment. Before they only have like 32,000 down payment, and then when they buy the townhome, they have 57,000 down payment because of the equity increase.
That's right. It doubled. Right. So in
And
5 years,
then
it doubled.
yeah, and then now 10 years later, that they can sell that property again, and this time that their equity now go up to 275,000.
That's right.
And then they can use this down payment to buy a bigger home, and this time the home is $1.5 million. And so they have 20% down for a bigger home. So this how people going up from a little condo to a townhouse to a single family home. And that's what you call a rising ladder, right?
Climbing the
Housing ladder.
housing ladder.
Yeah,
Yes.
climbing the housing ladder.
Right.
So yeah, so I just kind of recap what you just said, so people who following us will be clear. Yeah.
So yeah, so like I said, you start, let's say when you're 30 years old, you come up with that $30,000 to get into that starter condo, and 15 years later, you got, 10 times as much, 300K built up in equity, and you use that to get into your dream home, to put that 20% down on your dream home. Okay. So this is a surefire, tried and true way, to build up wealth in real estate, build up your portfolio. Okay. And then there's also variations on this. I can move over to the next chart if you don't have any other questions on this. I mean, is this pretty clear how you're trading up and you're
Yeah, you can
using
go ahead
time,
and move it. Yeah.
on your side, to build up your appreciation and slowly pay off the loan to build up your equity, and then taking that equity and putting it into the next property, selling, your previous house and buying a new house. And you can continue to do that as obviously as many times as you want over your lifespan. But at some point, I think you could do a 3-step process here and pretty much get into your dream home in 15, 20 years. Okay. So this is essentially basically what I did. I mean, I started out with just a little starter condo, and jumped into a 3-bedroom, 2-bath after that. And then I didn't go into my dream home, but I just started buying, rental properties and stuff like that at that point. And that's another one of the strategies here we'll talk about on the next chart. Okay. So now here's variations on that climbing the ladder theme. Just to reiterate what we did on climbing the ladder, you buy your starter home, right? You live in it, 5, 10 years. Time is on your side. You build up the equity through appreciation and paying off the loan. 5, 10 years later, you sell it and you use that equity to trade up, okay, to a bigger, better home, maybe bigger home or nicer neighborhood, whatever you want. And then you can hit the repeat button, okay? 5 or 10 years later, you can do the same thing. You can hit the repeat, right? And then in 15, 20 years, you're going to be up to your dream home. Okay. So evaluating this, I would consider this to be a very low risk approach. Okay. This is almost a tried and true approach. If anybody wants to get into real estate and you need, and you just want, you don't want to get involved with rentals or, dealing with the public. You just want your own home. This is a very low risk approach. You buy the home, it's for self-use, it's for comfort, it's for your family. Okay. You're going to take care of the home. It's going to be well maintained. Okay. So this is a low risk approach. Okay. And you're going to get the best appreciation out of it. You're going to get high appreciation because single family homes that are owner occupied have the best appreciation. Okay, so that's what we're doing here. We're buying a single family home and we're owner occupying it, and we're going to get the best appreciation out of it, right? And your equity is going to build up, the fastest, either through time, through appreciation, or you can even make, faster loan payments if you want, to pay off the house if it's your final home. So what we're doing here is we're leveraging, a double leverage here. We're leveraging the bank's money to get into that first home. After the 5, 10 years, when you have all that equity into the home, you leverage that equity to get into the next home. Okay. And you keep repeating. And like I said, you don't even have to worry about taxes because there's this capital gains exclusion, which is 250K if you're single or 500K if you're married. Okay, so if you go back to this scenario, you got 70K appreciation. You don't have to pay taxes on that if you're single. You got 275K appreciation on the townhome. Well, okay, if you're single, your exclusion is only 250, so you'd have to pay taxes on 25K. If you're married, it's a wash, right? You're up to 500K here on this home. When you hit the 500K mark, you're going to have to start paying taxes if you decide to sell your dream home. Okay. So you can see there's many, many advantages to this climbing the ladder technique. I would certainly recommend it, for first-time buyers or people that are interested in getting into real estate. This is how you start, and this is how you do it. Keep stepping up, keep trading up. Okay, very important. Okay, let's talk about a variation on that. Let's look at alternative one here. Okay, let's say you buy it and you don't want to live there, you want to rent it out. Okay. So now you get cash flow at the same time as you're building equity. Okay. And when you do sell, you can do that 1031 exchange, which is a tax deferred exchange. Okay, so you can use the same concept as trading up every 5 or 10 years. You trade up and you repeat. So let's say you buy a single family home and you rent it. After 5 years, you decide, okay, I'm gonna cash out on that and I'm gonna get a duplex. Okay, then you sit on your duplex for 10 years, and 10 years later, you decide to build up that equity, cash out on that. And now 15, 20 years later, you're into a fourplex. Okay, so you can do the same thing. You can repeat every 5 to 10 years and trade up to the point where you're going to be in an apartment complex. In 20 years, you could have 10 to 20 units. Okay, so you get the advantage of the cash flow plus you're building equity. Now, if I had to evaluate this, I would say, well, this is not low risk. There's some risk involved here because now you're dealing with the public, you're a landlord, you're dealing with all the issues of having to deal with tenants, right? Rental properties don't appreciate, as fast as single family homes that are owner occupied. So you're not going to get the highest appreciation. Okay, so there's medium risk, okay, because you got to deal with the public and tenants. You quite don't appreciate quite as fast. There's landlord issues you have to deal with, but you do get this 1031 tax deferred exchange. So anytime you want, you can trade up to a higher value property and defer your taxes. So you never pay taxes on it until you decide to get out of the real estate market, or you transfer it to your children through your estate. And there's like what, a $5-6 million exclusion. So you don't have to worry about your heirs don't even have to worry about paying taxes. Okay, if you pass it through your estate. Okay, so that's alternative one. You just want to go into multifamily. You want to go into the rental market. Okay. So let's say we do a variation on that. Let's say we do both. Let's say we're going to buy a property and we're going to live in it. Okay. And we live in that property, let's say for a couple years or whatever, short period of time, and then we decide to rent it. Or better yet, let's say we build a couple of ADUs in the back so we can live there and rent it. Okay. Now you got cash flow going at the same time that you're building up equity. Okay. And then when you sell this property, if you're living there, you still get the capital gains exclusion. But if you rent a property for 2 years and it's documented on your tax returns, you can still do a 1031 exchange. So you can trade up, okay, get into a better property. So this strategy combines self-use, meaning it's your home, with investing. So like I said, if you rent a property for 2 years, you can do the 1031 tax exchange. It's a tax deferred exchange, right? Or if you live in a home 2 out of the last 5 years, you're also eligible for the capital gains exclusion. Okay. And it turns out that
I have a
you
question.
can actually do both of these. You can actually do both. You can actually sell a rental property that you previously lived in and do the tax deferred exchange. And then when you do finally pay taxes on it, you get the capital gains exclusion because you lived there 2 out of the last 5 years. Okay. So anyways, that's a really important aspect. And
I have a question, DJ.
yeah,
So when you say you 1031 exchange, 1031 exchange is only used for rental property?
correct.
Do you mean that they live in the property and then over 2 years and then now they rent it? Or they live in it, they still live in it and they still rent it? They can do
Um,
both and then they then still use 1031 exchange?
um, well, I don't know exactly. If you don't live there and it's completely a rental, you definitely can do a 1031 exchange. Okay.
Exactly, yeah.
If you're living on the property at the time you sell it, I believe you cannot do a 1031 exchange because you're not using it primarily as a rental property, rental income. It's not 100% rental property. Okay.
Uh,
So
Here is what I understand, okay? For if, of course, when you, because when we live in the property more than 2 years, we get our capital gain tax exemption. And if we, at the same time, we rent it, I don't think we can use 1031 exchange if we, like, we live in our main home and rent
correct.
the
Correct. I
ADU.
agree. I
I don't
agree.
think we can do 1031 exchange.
Correct. I
I know
agree.
one case,
I
one
agree.
case when you rent a property for like 10 years, and now you move and you live in there. And you live in there for 2 years or whatever year you live in there, doesn't matter.
Right.
But as long as you live more than 2 years, you also qualify for capital gain tax. But now the situation is really tough to know how much you can get on the capital gain tax exemption, and how much you can do the 1031 exchange, because that will have to have
Right.
some CPA to come in and do the calculation.
Right.
Yes, we can do rent and then live in, and then we can still apply 1031 exchange, and we can still, I think, I don't know, but
Yeah.
this one would be, we need a CPA, right?
Uh, well, I don't think it's really that complicated, but how I would play this is if you buy a property and you want to live in it, like you said, 2, 3 years, and meanwhile you're building ADUs so you can turn it into a really nice rental property. You could have up to 4 units on it. Okay, I would say at some point you need to move out of that income producing property. You move out and it becomes 100% rental income property. And if you do that for 2 years before you sell it, you get the advantages of the 1031 exchange, plus the fact that you lived there 2 out of the last 5 years. You're still eligible for the capital gains exclusion. Okay. But the scenario you were presenting is you build all these ADUs and you get rental, plus you're living there at the same time. And then you decide to sell it. No, I don't believe you're eligible for the 1031. So you actually have to move out of that property for 2 years and have it as an income producing property for a minimum of 2 years on your tax returns. Okay.
That's clear now.
That's
That's clear.
clear. Right. That's clear. That's how you do it. So let's say you buy a property, you hold it for 5 years, you live in it for 2.5 years, and then you rent it out for 2.5 years. You're eligible for both of these tax advantages, the 1031 exchange and the capital gains exclusion.
But I can encounter a situation where our clients do live in the property for 2 years and then rent it out for a year and a half. And when he sold it, um, his profit, his appreciation, just equal to the amount of the capital gain tax. So he just pulled out completely. He doesn't need anything else. So I'm not even sure I don't think people want to do the 1031 exchange at that point, because they have to use all the money, everything he has, put it back into the property. It's not gonna profit him. I think he just used his 1031, the 500,000 capital gain tax exemption to get
Yeah.
out of it and
Yeah.
bring all money home and do whatever he want to do it. Because when he do 1031 exchange, he kind of stuck with it.
Right.
Yeah, that's what
Yes.
he did.
Yeah, it's a matter of again, if you're the investor, it's a matter of what you want to do. Do you want to turn this into, like I said, trading up on rental property? Or do you want to say, okay, forget it. I just want to go buy, a nice single family home. And let's say I want to, trade up in a better neighborhood and I want to take advantage of the, what is that, Prop 60 or something, where you can transfer your property taxes over. So there might be rationale to do that, to say, nope, I don't want to do a 1031. But there is there is an avenue here for you. Okay. So number 3 shows you that possibility. You can buy there, you can buy your property, you can live on it, like I said, 2.5 years, rent it out completely for 2.5 years. Then you can take advantage of both the 1031 and the capital gains exclusion. If you move back into the property and sell it, I don't believe you're going to get the 1031. But you can still get the capital gains exclusion. And if it's your primary home and you want to move into another home, you can also get that tax. What is that? That transfer of your property taxes of a lower property tax to a higher value home, Prop 60 or something. I'll look into that when I do the next course on tax advantages.
That's awesome.
So anyways, yes. So that's all I wanted to talk about today, was how to climb this housing ladder. It works for self-use single family homes. I mean, it obviously works for multifamily homes. Like I said, I don't believe multifamily homes, are going to get quite the appreciation as a single family owner occupied. It'll get your highest appreciation. Income properties don't appreciate as high, but there's several advantages to doing that. Okay. So these are the different variations here. And then next, we'll go and we'll start wrapping it up now, talking about some of the key takeaways. Okay. And then next week we'll throw out, TJ's Pearls of Wisdom on my 15 keys to success.
So we are done with today, right?
Yeah. Yeah.
Oh, okay, that's awesome.
So
So, I appreciate your time, DJ. So everybody, I think you learned something from today's section. It's about how to climb your housing ladder. It's amazing. I think everyone, if you want to get into real estate industry, it's time to do so. Can you stop sharing, DJ?
yeah, let me see if I can do that here.
Go to up, yeah, this.
Yeah.
So hello everyone. So I hope you learned something today, and you see, getting into the real estate market is the key thing you want to do, because the longer you are in the real estate market, the more equity you build for yourself. So please do, we remember to where are we? So do remember, you want to get into the real estate market, and do not let the interest rate stop you. Do not let anything prevent you from owning a real estate property, because the money you holding in your bank account, it lose its value because of inflation, and only the home appreciation beat the inflation rate. So for example, you have $200,000 right now, you don't buy anything. Guess what happened with that 200,000 5 years later? Right now with a $200,000, you can put down 20% for a $1 million home, and you can still find a home like that in the Bay Area. But 5 years later, if, for example, you still have that $200 to 1,000, for example, you the home value at that time is no longer $1 million, okay? And your down payment is not 20% anymore. On top of it, you might use it. You have that money, because you never know. You might want to travel. You might want to buy something nice for yourself. Things happen. People, just like when they have money in the bank account, what do? They spend. So if you keep your money, you lose it, the the value of the money, and you might even spend it for nothing, for some fun. But if you buy a home, you get into real estate market, you're building your equity. And from one small little property, you can buy a bigger one 5 year, 10 years later. So that's what TJ just showed all of us. So if you have any question regarding to how to jump into the real estate market with your current situation, do not afraid to contact me. I'm a loan agent. I can help you to do pre-approval. I can show you step by step how to buy a property. And my number 408-393-2068, 408-393-2068. And DJ, if people have question regarding to investing in real estate or how to build an ADU, how do they reach you?
Yeah, please, you can reach out to me 408-214-1494. I do offer these no-cost feasibility studies. I'll be happy to come out and do a site survey, look at your property and brainstorm with you and come up with the best opportunities, how you can get the most sweat equity out of your property, and how to actually help accelerate your appreciation and equity in your property. And like I say, with the new ADU laws, I mean, heck, you could basically put a fourplex together, either a triplex or a fourplex. And here where I am in Sunnyvale, they allow you to build as many ADUs as you already have existing units. So you can take a fourplex and build four more, or take a triplex and build three more. I mean, it's just amazing, how California is getting aggressive now to solve, the housing crisis. So we're in an opportune time. I mean, this is a golden opportunity, as MC was saying. So take advantage of it. As she was explaining, you got 200K. Well, the cost of money goes down. The value of your money goes down over time with inflation. Okay. So, you're much better off putting that money into a good investment where it's going to
Yeah.
grow, that's, if you got debt equity in your house, talk to MC, take that debt equity out and go do something. Or if you're ready to trade up, trade up, get into that, next level of that housing ladder. Whether
So
it's
I just thought of something, I think you should want to think about owning something that something appreciate in terms of money in the future. Do
correct.
not buy things because you like to buy it, like a toy. like a very nice fancy camera or very nice fancy watch or a very nice fancy car. Um,
Right.
don't lose money value on those fancy toys. Instead, own something that grow in value in the money term. Okay.
That's right. All those depreciate. They don't appreciate. All those, all those toys depreciate. Real
And
estate definitely appreciates out here. 7%, it's climbing at record appreciation rates. Now we don't know what's going to happen with the new administration, whatever, but still, historically, you can't beat it.
And it's funny when you buy such a fancy toy, you don't even think twice. You just buy it. But when you buy a house, you think 10 times. That's a wrong thing to do. Just go for it. I
Yeah,
think because when you buying home, it's a big decision. You scare yourself and you try to think so much to push yourself away from owning a home. That is wrong. When your monkey mind telling you what not to do, that's the time when you should do it. Because that monkey might always try to scare you, and do not let it scare you. Uh,
right.
do the right thing. Knowing because we've been talking about real estate all along. If you're gonna go back to the previous video, it's we talk about how you can jump in the market, how you invest in real estate to make a lot more money for yourself in the future. You don't want to rent a property forever. You don't want to rent for the rest of your
No,
life.
no,
That a
no.
no. You want to own something. So
That's right.
again, just want to make sure you are doing well, become wealthy, rich, whatever, retire early. That is my goal. That is TJ's goal too, right,
Yeah.
TJ?
Yeah. Yep. Of course. I mean, at this point, it's about sharing the love, not chasing money anymore. So
Okay.
that's a
Yeah.
good
Awesome.
position to be in. It's
Awesome.
time to teach and train others how to do that. So that's why I'm
Awesome.
here.
Awesome. Awesome, TJ. All right. Thank you so much, TJ, for
Right.
your time. And thank you, everybody, for watching.
Yep.
I love you. I will see you again next week, right, TJ? We have another,
That's right.
we're going to see
Yep.
you again next week.
Yep.
More wisdom from TJ.
That's
Okay.
right. Right. So yeah,